Welcome back. All right, our second method of depreciation is called double declining balance. It produces a large amount of depreciation in the beginning, in the first year, and smaller amounts going forward. Because double declining balance method recognizes depreciation expense, it's called an accelerated method because, again, you're taking a lot of the depreciation up front. And there are several steps to this. The first step for double declining balance is called determining the straight line rate. Now, if you remember, our van had a 4-year useful life. Well, to calculate the straight line rate, we're going to take that 4-year useful life and divide it into 1. So 1 divided by 4 is 0.25, 25%. That's our straight line rate. Number 2, we're going to double that because obviously it's called the double declining balance rate. So we're going to double that 25 to 50. So 50% is our double declining rate. In step 3, we're going to multiply that rate times the book value of the asset at the beginning of the period. Remember, book value is the cost of the asset minus accumulated depreciation. So looking at the table in year 1, the book value of the van is $24,000 minus 0. We have no accumulated depreciation yet. So 24,000 times 0.5, our depreciation expense for year 1 is $12,000. In year 2, we now have accumulated depreciation of 12 grand. So 24,000 minus 12 is 12. 12,000 times 0.5 gives us $6,000. So that's our depreciation expense for year 2. Now, between year 1 and year 2, our total accumulated depreciation is 12 plus 6, or 18,000. You'll remember that the cost of the van was 24 and the salvage value was 4. Therefore, the most amount of depreciation we can take, or our fully depreciated van would be $20,000. So since we've already taken 18, we only have 2 left. So in year 3, even though we have $18,000 of accumulated depreciation, subtracting that from 24,000 gives us 6. 6,000 times 0.5 would give us $3,000 of expense, but we can only take 2 more. So that's our depreciation expense in year 3, $2,000. So 12 plus 6 is 18, plus 2 is 20. We have fully depreciated the van. And in year 4, we get no depreciation expense at all. Regardless of the method used, an asset cannot be depreciated below its salvage value. So here are the financial statements under double declining balance. Notice here's our depreciation expense, and we said it's going to take a lot up front and less going forward. So we get 12,000 in year 1, 6,000 in year 2, 2,000 in year 3, and nothing in year 4. And you'll notice that the carrying value is changing. 24,000 minus 12 gives us a carrying value of $12,000. Here, the carrying value is 6. Here, the carrying value is 4. And it's going to stay at 4 until we either sell the van or we get rid of it. Suppose rental demand for Dryden's van depends on general economic conditions. So what if the demand is based on what's happening in the economy? In a robust economy, travel increases and demand for renting vans is high, as demand for renting cars is high right now, and it's been for a while because we haven't had enough cars, basically. In a stagnant economy, demand for van rentals declines. In such circumstances, revenues fluctuate. So that's why we're going to use units of production depreciation. In that case, units of production really fits for a car because if you think about your car, it loses value. So assume Dryden estimates the productive capacity of the van to be 100,000 miles. First step to compute the cost per unit of production. Now this numerator should look very familiar to you, right? This is what we used for straight line, cost minus salvage value. Now in straight line, we divided by the number of years of useful life. In units of production, we're going to divide by the total estimated units of production, in this case, 100,000 miles. That gives us the rate. Now we're going to multiply that rate times the number of units produced in the current year, and that gives us our annual depreciation expense. So looking at the van, as we said, depreciation cost per mile is going to be 24,000 minus 4, so 20,000 divided by 100,000 miles. Our units of production rate is 20 cents per mile. Looking at the chart, in year 1, the van was driven 40,000 miles. So we take $8,000 in depreciation expense, 20 cents times 40 grand. In year 2, the van was driven 20,000 miles. So 20,000 times 20 cents is $4,000. In year 3, it was driven 30,000 miles. So 30,000 times 20 cents is 6. And at this point in year 3, we have again $8,000, $12,000, $18,000. Our maximum depreciation is 20. So even though in year 4 the car was driven 15,000, or the van rather was driven 15,000 miles times 20 cents, that would give us depreciation expense of 3 grand, but we only have 2 left. So that's the depreciation expense in year 3. 8 plus 4 is 12, plus 6 is 18, plus 2 is 20. So assume Dryden Enterprises retires the van from service and sells it on January 1st. So we've used it for its full year, so it's fully depreciated. And in year 5, we're going to sell it, and we get an offer of $4,500 cash. Well, at this point, the book value of the van, remember, book value, cost minus accumulated depreciation. The book value, 24,000 minus 20, is the salvage value of $4,000. So because we're selling it for more than we have on the books, we have a gain. So we debit cash for the total amount we were paid, $4,500. We're going to debit accumulated depreciation for the amount that we have in there, 20 grand. We're going to credit van for the cost of $24,000. And the difference between 24,500 and 24,000 is a gain on sale of van for $500. The maximum depreciation currently allowed by tax law is computed. Now, the government says you don't get to choose. Straight line, double declining balance, units of production. You don't get to choose the method for depreciation on your taxes. You have to use our method, and the government's method for tax purposes is called MACRS, Modified Accelerated Cost Recovery System. MACRS specifies the useful life for designated categories, and they have 3-year, 5-year, 7-year, 10-year, 15, and 20, and for real property, they go even higher, 25 and 30. So if we look at the MACRS tables for 5-year property, now 5-year property would be considered computers, that kind of thing. 7-year property could be furniture. So look at the 5 and 7 year, and do you see anything unusual about these two schedules? Because I do. How many years do you depreciate 5-year property? 6. And 7-year property? 8. So why is that extra year in there? Well, because it's called the half-year convention. In order to not have taxpayers calculate the exact amount of depreciation from the time they bought it in year 1, and for the time they sold it in year 6, they just give you half. So we get half in year 1 and half in year 6. Notice, what's 1/2 of 1152? 572, 576. So there's your 5-year and 7-year schedules for makers. All right, using makers, assume that Wilson Company purchased furniture, which is considered 7-year property, for $10,000 cash on July 21st. Tax depreciation charges over the useful life of the asset are as follows. So again, we don't care about July 21st because we get that half-year convention. Using the 7-year table, and here it is, we get 14.29 for the first year, 24.49 for the second year, 17.49 for the third, and so forth. Till we get to year 8 is 4.46. What's the difference between maker's depreciation and financial accounting depreciation besides this 7-year, 5-year table thing? Notice, we depreciate the entire amount, the entire asset. We don't take off salvage value when it comes to taxes. Now, because we're dealing with estimates, of course, there are going to be revisions. Estimates are frequently revised when new information surfaces. So, McGraw Company purchased a machine on January 1st, year 1, for 50 grand. They estimated the machine had an estimated useful life of 8 years and a salvage value of 3 grand. So their straight line depreciation is cost minus salvage value, so 50 minus 3, divided by 8. So the depreciation is $58.75 a year for the 8 years that they're going to use the machine, hopefully. Now we're going to assume that after 4 years of depreciation, in the 5th year, accumulated depreciation is going to be 4 times $58.75, or $23,500. Subtracted from the $50,000 cost would leave us a book value of $26,500. Now, if they revise the expected life to 14 years, what's happening there? Well, they started at 8. They've used 4, so there are 4 years left on the original estimate, and now they're adding 6 years. Instead of 8, they're saying 14. So we're going to add 6 plus the 4 remaining from the original would give us 10 more years instead of 4 years of depreciation. So we're taking book value, 26.5, minus the salvage value, divided by the 10 years remaining, and our depreciation expense now is reduced to $2,350. So that's a revision of life. What about a revision of salvage value? Alternatively, assume the original expected life remained at 8 years, but McGraw revised its estimate of salvage value to $6,000 instead of 3. Well, we're going to take the book value of 26.5, just like before, because we've already taken 4 years of depreciation, subtract the $6,000, the new $6,000 of salvage, divide by the 4 remaining years on the estimate, and our depreciation is now $5,125. It went down a little bit because we're estimating that there's going to be more left over at the end. The salvage value is higher. So that's revision of salvage value. Now, most plant assets require additional expenditures. You can relate to this. You have to do oil changes on your car. You have to change the tires. Kind of basic things that you do to keep the car running. Accountants must determine if these expenditures should be expensed or capitalized. For the most part, costs of routine maintenance and minor repairs, and that's where it kind of gets fudgy, that are incurred to keep an asset in good working order are expensed. So we're going to have a repair expense account. So assume they spent $500 for routine lubrication and replacing minor parts. We're going to debit repairs expense and credit cash. And that's an operating activity. Costs that are capitalized. So what gets added to the asset? Substantial amounts spent to improve the quality or extend the life of an asset. Now, we're not changing the estimate of the life. We're actually making an investment in making it last longer. So this differs from that other one that we looked at. These are called capital expenditures. Capital expenditures are accounted for in one of two ways, depending on whether the cost incurred improves quality or extends the life. If it improves the quality, the amount is added to the historical cost. So recall that the machine originally cost 50 grand, had an estimated salvage value of 3,000, and had a predicted life of 8 years. Recall further that accumulated depreciation at the beginning of the fifth year was 23.5, was 58.75 times 4. So the book value is again $26,500. If they make a major expenditure of 4 grand in the fifth year to improve its capacity, the debit goes to machine and the credit goes to cash. So we're actually increasing the asset's cost. After recording the expenditure, the machine account balance is $54,000 because we added the 4 grand, and the book value is now 54,000 minus the 23.5, or $30,500. So we changed the book value by adding to that asset. So now we've got 30,005 minus the salvage value divided by the remaining 4 years, and our depreciation expense goes up to 68.75. That's that was improving the machine. And we're going to get to part 3 right after this.